All right, welcome everyone. It's time for an exclusive episode. I just got done actually releasing a public episode, the one on buying the tariff dip. It's always a fun subject to talk about is anything where there's some contention, disagreement, some bartering going on, always makes for an interesting topic. We'll see how that video does. I never know quite how they're going to go, but it just goes over the case and that I bought the dip. And the main argument, the main point of the video is there are things that I think that have a long shelf life, things that will have an impact on a company for the long foreseeable future, things that impact them intrinsically, that really move the needle with the true value of a company. And tariffs by executive orders are just not it. It's not something that I factor into the intrinsic value calculation of a company. So another way of explaining this, and I could have spent more time on this in the video, but I wanted to make it short and sweet. But something that you can think about with a company is every stock. If you pick a stock like Booking Holdings, for example, the one that I bought more of, every stock has these bars that represent 1 year of revenue, 1 year of free cash flow, or these line items, right, on a tabular sheet, 1 year of cash flows. And you're buying a company, equity in it, for the entire life of the company. If you're a long-term shareholder, you're buying it for its life. The company's intrinsic value is when you add up all the cash flow it'll generate, all the excess profits over every single individual year, going out 20 years, 30 years, 40 years. For the entire lifetime of that company, you accumulate all those cash flows together, and that's what the company's worth when you discount it by the time value of money and the risk involved. So you have a little bit of discounting to do. That's where you factor in the amount of time it takes to earn that money, and then the amount of risk or predictability that it's going to generate these incomes. So when I look at tariffs, when I look at recessions, when I look at things like lockdowns and these type of issues, there's a couple ways that they can work out. It's almost always temporary. If you have a recession, if you have a tariff war or anything like that, we've seen this before. It's not the first time we've seen it. We had similar things back about 10 years ago, and they're temporary. There's disagreements, there's meetings, there's concessions made, and then there's agreements made. And what it does is for the company over the 20, 30 years of cash flows it generates, it might impact them for 1 or 2. So out of a company where you're looking 30 years out, you have 1 or 2 years that are slightly impacted with their earnings per share. Now, if you think about that, just through the rational context of you're buying a company based on all these different cash flows, all these earnings going out 20, 30 years, does it really change the intrinsic value if 1 or 2 of the years are impacted by a small percentage? Not really. The overall intrinsic value is about the exact same. So that's how I look at it with these type of events. It just doesn't factor in. And like I've argued, if you're buying exceedingly good companies, the best ones in the world, they actually have a way of benefiting from these type of events. Because if it's a shock to the economy, if it's a shock to the markets or to business or commerce, the strongest survive, the weakest go out of business. When the weaker ones go out of business, that's how bigger companies gain market share. They gain the lost customer that will eventually come back. And that's what we saw throughout history, throughout every recession, throughout all these type of battles. Now, in the other scenario, let's just say that this is a long-term issue, that it causes destruction and devastation over the next 10, 20, 30 years, then it doesn't really matter anyway. We're buying stocks so that we can retire, that we can have a prosperous future. And if everything just goes down the drains anyway, then it doesn't really matter. There's nothing we can do in that situation anyway. So either way, the best possible outcome, I believe, is in situations like this to simply buy the dip. And that's what I'm doing. It's what I'm doing with my money. I'll continue to buy it if this happens. I think more than likely it's going to be very short-lived. Now, if we look at what I typically do every month, I release a Joseph Carlson holdings sentiment spreadsheet. This right here is my sentiment towards every holding. And sentiment meaning how I feel, how I interpret the situation these companies are in right now. And I publicize this. I'll do it again with this video. So you're going to have this paper, this image to follow along with. as I go through it, but I thought it would be interesting to just walk through it with you because I went and redid all of this. I renewed all the analysis. I kind of did a little mini write-up on all of it to give you my current sentiment. Now, one thing I want to point out is undervalued does not mean I'm currently buying the company. Because if I already own a lot of it and I feel like I have a lot of exposure to it, even if it's undervalued, I may not want to increase my position. Overvalued doesn't necessarily mean I'm selling. For example, one of the companies I think is overvalued is likely Costco. But I'm not selling it because even though I think it's overvalued over any kind of 5-year or 10-year basis, I think over the super long term, 10 or 20 years, it's still a decent holding. So this doesn't mean that if it's undervalued, I'm necessarily buying it, or if it's overvalued, I'm necessarily selling it. These are just my current sentiment. If I think a stock is really cheap and a really good buy, or if I think it's fully valued and it's trading at very high valuations. This is meant to portray my general sentiment to my holding valuations. And as always, there's no guarantees. In many cases, stocks that are overvalued continue to surge up. Momentum plays a huge part here. So I wouldn't take this as meaning that if I mark a company as overvalued, it's not going to go up. Like, I'm not going to be shocked if Apple goes up or if Costco goes up. I'm just not. And Costco has gone up a lot while it's been in the overvalued category. So there is some nuance to be said here. Now let me go through them one by one. We can take a look at them here. MasterCard, it's my second largest holding. I've been very impressed with the strong performance and adaptation of both MasterCard and Visa. And I believe the moat has only gotten stronger of these companies over the past 5 years. They face many competitors. There's many ways to transfer money digitally, and that's always existed. You can hear the CEO of MasterCard in an interview go through the entire political landscape, the entire geographic landscape of all the different countries and territories, and all the different ways to transfer money. But MasterCard evolves, they buy different technology, they develop different teams, they integrate stuff into their network, and they grow. And this company in particular is a hedge against inflation. Inflation means that prices go up, which means that MasterCard's slice, their percentage they take also goes up. So their growth is always a little bit above inflation, and that's a really good business model. I view the company right now as fair value. Now, in terms of the valuation again, it's just a basic sentiment. And the reason that I don't give a specific price point is I view it more in ranges. Fair value, it just means that I think it's reasonably valued. I don't think it's extremely expensive. I don't think it's extremely cheap. I think it's in that range of being reasonably valued. If I think a company's really cheap, that means that I think it's like it has to hit you over the head. It's just obviously a good buy. And I've seen that many times throughout history. MasterCard isn't in that category right now. It trades at a 30 forward PE ratio on 2026's earnings. We can look at it here if I go to the preview of the updated section of Qualtrim. We can see the next 12 months EPS. Here we go. This is going to be updated soon, by the way. It got a little delayed. We're working with some currency issues, but we have here the PE ratio over the next 12 months is 35. So in the mid 30s, that's a pretty high valuation for a really good company, but MasterCard's exceptional as a company, so it makes sense. 30 PE ratio based on next year's earnings. So I think it's just fair value. I don't think it's extremely expensive. I don't think it's extremely cheap. I think it's right in that nice middle spot. We go to Intuit. Intuit stock is down 5% over the past year. So if you highlight this company, you'll go, Joseph, it's going down. Does that mean it's cheap? Well, you gotta put this in context a little bit. It's down 5% over the past 1 year. After being up plus 60%, that should say in 2023, not 2024. So I'll fix that. In 2023. So it went up 60% in a year, and then it just stayed flat. And that's how it works out. That's a 2-year performance of plus 60%. While it's discouraging that the trailing year performance looks bad, when averaged over the 2 years, that's plus 24% per year performance. That's pretty good. So even though the company has been flat, going back a year, when you just zoom out a little bit further and you annualize the returns, you got a decent performance of 24% per year. Intuit trades at a 27.4 PE on 2026 earnings. I believe it trades flat. If it does trade flat this year again, I think it moves into the undervalued territory. But as of right now, I think it's fine. It's taken a breather. Doesn't cause me concern. When you look at the fundamentals of Intuit too, like we can bring this up here. Even though the stock has been flat for the past year, and again, 29 PE ratio, 26 PE ratio based on 2026's earnings. Even though it's traded flat for the past year, we look at a few metrics. The revenue grew 12.48%. The free cash flow grew 18%. The free cash flow per share grew 18.5%. The intrinsic value of the company is growing, and that's what I anchor to. I'm anchored to the intrinsic value. So I see a company trading flat, the intrinsic value is growing. That's a fine situation to be in. It's only a matter of time until the company starts to trade again with its intrinsic value and move upwards. Moody's is up 7% year to date and 24% over the past 1 year. The fundamentals remain the same. The company is compounding its price in line with its intrinsic value growth. I don't see it as a particularly good buy or a particularly bad time to buy this company. Therefore, it's fair value. If we look at Moody's, it's just right down the middle. Great company, not a particularly amazing time to buy the stock. Like, we're not in any huge dip, and it's not also a horrible time to buy the stock, in my opinion. We go down to Texas Roadhouse. Texas Roadhouse is flat year to date while being up 38% over the past 1 year. The forward PE estimates and free cash flow yield are reasonable given the excellent market position and execution of this company. I continue to be enthused by what I see. People love the restaurant. They still love it. Whenever I see anybody on social media, they look forward to going there. The experience is top notch to get out, have fun, have an affordable steak dinner. There's always going to be some restaurant that has a better steak, but in most cases, that's going to cost you $60, $50 for a really good steak. Texas Roadhouse has met that nice area where it's a pretty good steak, better than what you can cook at home in most cases, and it's relatively cheap. So when we're looking at Texas Roadhouse, I wouldn't be surprised if it grows a little slower this year than the last year due to price pressures, but I remain bullish on this company. This is one that, like I pointed out in the last episode, if you've seen it, they really benefited from COVID. And the reason why is because during that time period, so many different restaurants went out of business. The rent obligations and the leases just crushed them. So they can't expand. They're burdened by leases. They're burdened by paying back their, all the expenses they have, the employees, all that time period. Texas Roadhouse was actually, if we look at the earnings, they actually remained profitable, positive EPS, even during the worst of COVID, the worst time period. And that made it so that they could bounce back with a vengeance. That's the benefit. I always say that I like companies that don't have a lot of debt, and that's the benefit of having no long-term debt. So this company bounced back with a vengeance. The speed at which it grew accelerated after COVID than prior to it. And a lot of that has played out. Texas Roadhouse has had exceptional performance. But I think a lot of those tailwinds of them gaining that market share have already been had. And so I think the growth will slow down a little bit this year. I really do. Not enough that I think it's a sell and it's a fire alarm for this stock. I just see it as being a little bit less exciting this year than it was the past 2 years. In my opinion, it's fair value. Microsoft, we have another fair value. Microsoft is flat year to date and flat over the trailing year. It's another one that's just been hanging around the same price. During that time period, Microsoft has grown revenue and earnings by 12%. The Azure cloud business has grown by 20%. The valuation is not extreme on the either end. I believe it's only a matter of time until Microsoft continues to grow in line with its fundamentals. Again, it's okay that a company's stock price trades flat when the fundamentals are growing like crazy. This is just pricing. Sometimes it takes a bit. Sometimes stocks go up too much and the fundamentals need to catch up. And sometimes, the stock doesn't go up enough and the stock price will catch up to the fundamentals. With Microsoft, I think it got a little ahead of itself and now it's playing catch up with the fundamentals. So right now I think it's fair value. When I look at Vici, there's no real changes in my thought on this stock over the past month. It's just a position that I think is a little bit conservative for my portfolio, growing a little bit slowly. I simply think I have a little bit better options. So I'm likely to continue selling part of my position in Vici And I do note that it's been a profitable company. I'm around $8,000 in the green on this one, so it's been fun to make money in it. But I want to position my portfolio for extremely strong growth over the next 5 years. We get to Netflix, and this is one that I think my previous ratings on it were incorrect. I had it as fair value, and I probably should have just kept it as undervalued. I feel like even a lot of these companies now, fair value in my portfolio, I'm still bullish on them. I still think even these companies are going to beat the market. Otherwise, I just wouldn't hold them. If I didn't think they had a chance at beating the market, I wouldn't hold them. But with Netflix, this is a company that was so cheap at one point that I marked it as fair value because it was a lot less cheap. But over the past couple of months, Netflix has proven to investors that its intrinsic value is growing rapidly. That's what we saw. Netflix stock is up 10% in 2025, after being up 83% in 2024, after being up 65% in 2023. That is an incredible 2 years of performance plus the year-to-date performance. The drop in 2022 has set up one of the best stock recoveries of all time. Netflix has now even outperformed the NASDAQ from its stock price prior to the drop in 2022. Meaning that if you had bought this company even before the COVID drop, I did some buys during that time period, or not the COVID drop, even before the 2021 drop right here. Every single buy during this entire time period, even the very peak, has beat the S&P 500 and it's beat the NASDAQ. Every single buy. There's no place that you can buy Netflix over the past 5 years where it hasn't outperformed the S&P 500 and the QQQ. That's how undervalued this company was. Every single buy, every single one has beat the NASDAQ and the S&P 500. And I still believe, I don't think it's luck. I don't think it's just happen chance or that it's way overvalued. I think it's truly deserved by the performance of this company. And I think you're going to see a lot more of it over the next 10 years. Like I've said for some time now, this company has clearly shown to be an excellent world-class asset that has extreme power in organic growth, pricing power, flexibility with the free cash flow it generates, ability to do efficient buybacks, and so on and so forth. And the market that they're dealing with is massive. Media is a massive market. It's the scalability of content. You can create one show like Stranger Things, invest $100 million into it, or whatever they're investing into it, and then they can show that to every single person on planet Earth. So content is highly scalable. I love the business. It's going to go through some up and downs, but I expect significant free cash flow growth over the long term. In 2025, I think it's going to slow. And the reason why is because Netflix has announced that they're raising their content spend from $17 billion to $18 billion. It's a decision. They don't have to do that, but they're running away with the lead and they're furthering the distance. So I think that it's a good thing. They're expanding their content, investing more into the service. It's going to grow subscribers, going to increase their pricing power and all of that. I think earnings per share growth is going to happen at a brisk pace. When we look at Netflix, you look at the valuation, and this is what I love about this new feature. I can't wait till this goes public. It's not there right now. So if you're looking for this PE ratio, it's not on Qualtrim right now, but it's going to be very soon. It shows you the historical PE ratio over the past 12 months, the next 12 months, so 2025, and then next year, 2026. Notice how Netflix is cheaper every year, 48 to 39 to 32. That's what rapid earnings per share growth does. So I look at this company. I think it's going to get cheaper over time. I think the earnings per share will grow very quickly. They're in a very good spot. I put it as fair value only because it's not on an extreme deal. It's just traded up with a lot of momentum, but I still think it has very bright future prospects. Now we get down to the category. We're getting close to the undervalued ones. Salesforce. I think the company right now is fair value. I bought the dip in it. I bought it when I thought it was undervalued. Salesforce is up 42% in the past 6 months. There is a significant debate over the role Salesforce will play in the AI world. This new agentic world where agents are going around doing everything for humans. I've said this for a while. I don't think it's so much about the inventor or the creator of something that's innovative. I think it's about what company can actually utilize and implement and apply the innovation in the most fortuitous way possible, in the best way possible, the most fruitful way possible. For example, I've used the same example very frequently. The entire mobile video game industry doesn't make as much money on their video games as Apple does. Apple doesn't even create the video games. They just offer the distribution, the app store, the promotion, and the billing of transactions goes through Apple. Therefore, they extract the money, they capture the value out of the mobile video game industry more than any of those game developers. Now, again, there's debate of what's fair and unfair, and you can argue that, but that's aside from the point. The point is that not every company equally captures the value of the innovations and things that they create. With Salesforce, I believe Salesforce is uniquely in an advantageous position with its already large customer base network and information about customers and their customers' data. It's not about who invents it, it's about how they can use it, and Salesforce has the massive distribution. So they can create Agentforce, they can create AI, they can brand it themselves, and then they can plug it into their massive network, their database, all their customer data, and sell it as an additional product. And I think that positions them in a really good place. We'll see if I'm wrong. Maybe it's a wrong bet and somehow AI really disrupts them. But in this case, I don't think it's wrong. Booking Holdings, undervalued. I have changed Booking from fair value to undervalued. The stock has dropped nearly 10% in the past month. When I look at the simple valuation multiples, Booking Holding trades at a 22 forward PE ratio over the next 12 months, a 19 forward PE on 2026 estimates. The trailing free cash flow yield is 5%. Booking is positioned to buy back over $8 billion of its stock per year. Global GDP per capita continues to grow. So think of that. The median GDP per capita, the amount of wealth of each individual it's growing over time. And initially, wealth is created for necessities. So your initial wealth, you get it and you buy food, you get healthcare, you get the initial necessities. Excess wealth goes to things. So you buy extra things, you might buy an extra car, something like that. And then excess wealth beyond that goes to experiences. But we're at that point. We're at a point where a lot of the world is so wealthy. We have so much efficiency. We have so much automation that so many people are becoming so wealthy that we're having more experiences. This is a secular trend that I feel like Booking is well positioned to just ride. They don't have to do much. They're just already positioned in that spot. So I see that long-term story and narrative continue to take hold. When you combine that with the incredible fundamentals of this company, the very long-term ownership perspective that management has, the super cheap valuations, I just think it's really set up well. And so right now, I consider undervalued. I think buying into it now will outperform the S&P 500. I always have to give the caveat, I can't see the future. There's no guarantees. That's why I own more than one stock. With ASML, this is another one that I think is undervalued. ASML's most recent earnings report, their Q4 one, was fantastic. They delivered strong results across every metric. Management noted that they will no longer be reporting the net booking number in the quarterly report. Many investors read into this that it's a predictor of poor results going forward. I don't see it that way. I believe they want to lower the volatility of their stock by directing investors' attention to the long-term financial estimates of the company. Netflix did the same thing by saying they're no longer reporting subscribers. The stock is up 60% since they made that announcement. Apple did the same thing back in 2018. The stock is up 300 and something percent. Amazon doesn't report the amount of Amazon Prime subscribers. Microsoft doesn't report specifically the amount of Azure cloud growth. Companies report different metrics all the time because they want to direct investors' attention, in most cases, to things that they believe are more long-term. So even though ASML is not going to show the booking number on a quarterly basis, they are going to give their expectations on growth and assumptions over the long term. They are going to give GAAP financial estimates, and those are more meaningful. So I don't see it as a problem. I'm not concerned about that. I've heard the same concerns over and over again, and it's never really bothered me. Now get to S&P Global. This is another one that I think is undervalued. S&P Global continues to silently execute in the background. The stock underperformed in 2024, gaining only 13%, but it's off to a good start in 2025, gaining plus 5%. More importantly, the fundamentals are improving quickly. They posted 12% revenue growth and a 52% increase in free cash flow over the past year. They're quickly reducing their share count, doing buybacks, paying a growing dividend. I think overall the stock is just in a good shape. It's not, S&P Global I don't think is going to be one that just has extreme growth. It's not a meme stock, so it's going to have this steady compounding, but I do consider it undervalued over the long term. Amazon is still undervalued. Now, keep in mind, I have Amazon as undervalued after Amazon is up 8% year to date, after being up 44% in 2024 and 80% in 2023. Yet even after that, Amazon remains undervalued. Amazon can be looked at as 4 separate businesses. I have a typo there. There we go. It can be looked at as 4 separate businesses: a retail business, the largest online retailer in the world, an advertising business, the 3rd largest in the world, a cloud hyperscaler business, largest in the world, and an online video streaming business, 2nd largest behind Netflix. Each of these business lines are highly attractive and have strong secular growth trends. Each of them have huge operating leverage, every single one of them. So these are excellent businesses. And when you look at these businesses, specifically the high margin portions of it, Amazon is growing around 12% overall, but around 17% with the highest margin portions of their business. So the more profitable, better parts of their business, the better lines of business, are growing above the speed of the rest of the business. I really like the situation Amazon's in. I think it's got a good risk reward right now. With Google, we have another one I consider undervalued. Google's up 8% year to date while posting plus 41% returns over the past year. Yet even with these gains, Google trades at a 24 PE ratio. Free cash flow has been temporarily hit with the build out of large capex intensive AI cloud hosting infrastructure. I'm okay with these investments as I believe that they'll have a predictably high return on capital or on the amount of money they're putting in there. Overall, Google is the same. It's a collection of great businesses. I don't see them getting disrupted by ChatGPT in the same way other people do. I think Google's aware of all the information and organizing information, and I think they have a lot to offer in that category. YouTube is such a great business to be in, and I think they have kind of a little call option with Waymo. That could turn out really well, but it's certainly not reliant on Waymo. So I like Google. I think that the price reflects a lot of uncertainty when I have a more bullish view on the company. So I mark this one as undervalued. Then we get to the 2 that I think are overvalued. Costco, it's just, Costco, if we refresh this and we go up to Costco here, let's take a look at this one. Costco's a fun stock. I don't know what this is, so let's go to Costco there. Okay, we're on Costco, which big number there, $1,005 now. It's up 2% today. I mean, this is Costco. The whole world is concerned about, Canada and the US and our relationship and what's going to happen. Costco's like, we don't care. The stock's going up. Investors love it. It's an all-weather stock. Costco will be the last thing on planet Earth that exists if the world comes to an end. Like, it's just indestructible in my view. So I look at the company as having an extremely high terminal value, even though the short-term metrics look really scary. When I factor that in with the long-term, 30, 40 years out, when I'm an old man and I'm looking at Costco stock, I still think that over that time horizon, it will prove to still be a good purchase. Now, again, 54 PE ratio, 50 PE ratio, it's hard to say this is a great time to buy the stock. When I look at Costco, I see a trading range of anywhere from the 50s, like the mid 50s on the high end. And then on the low end, I see the low 30s on the low end. That's kind of the PE ratios that I see the stock trading around. I think it's a much better buy when you can buy it around here. So I don't think you buy it here. I think you buy it in the 30s. Now, where do you sell the company? I sell the company when it gets to the 60s, 65 PE ratios, 70s. That's when I start to take gains. It's just too much. But we haven't gotten to that part. So that's my view on it. There's certain tolerances that different investors have for valuation. I've read a lot of history, studied a lot of investors, and most great investors say that you should have a little bit more tolerance of valuations of companies that you currently hold. Not infinite, it's not worth an infinite price, but your tolerance should just be a little bit greater. That's what Phil Fisher says. You should have a superb reason to sell a stock. And in most cases, you never want to sell because of valuation concerns of a company that has a very bright future. They've done all this analysis on. So it's not that I'm saying Costco's cheap or that it's a buy today, but I do have a higher tolerance on a company that I think has a superb terminal value over its long term. Apple. Apple is a great company. I consider overvalued for a couple reasons. It's growing slowly, very slowly. Last year, Apple grew under 4% revenue growth and is projected to do so again for the full year of 2025. That's 3 years of almost no growth from Apple and growth that's slower than inflation. I have no reason personally, I can't think of any reason that Apple will have suddenly an increase of growth that analysts aren't seeing or that Wall Street's not projecting. Now, if I had a divergent view, if I thought the analysts thought there's going to be slow growth, but I think it's going to grow a lot faster, I would want to hold the stock and buy more of it. I don't see that happening. I see the analysts being mostly correct. At least I can't think of anything. Can you, of why Apple will suddenly grow way ahead of expectations? There's some investors like Dan Ives that cite Apple Intelligence. I don't know. I have Apple Intelligence. To me, it's not like a reason to go out and buy the phone. You know, maybe for some people it is, but it's not as big of a game changer right now that I think they'll have this massive upgrade cycle. At least I don't see that personally. Now, again, Apple is a great company. I have no reason to believe it will grow above estimates. And as a result, I believe Apple is becoming more similar to other high quality, predictable companies, but ones that grow slower. Companies like Coca-Cola, Walmart, McDonald's. Those are all fantastic companies, and they do fit in various portfolios. But for me, I'm reducing my position in Apple and putting my money into faster growing companies. I don't want companies that are growing at 4%. I don't even really want companies that are growing at like 8%. So even if you assume double the growth from Apple, that's still on the slow end. I want companies that are growing revenue 12% plus. That's a really great range to be in, and I hold many of those companies. So as I look at Apple in the current situation, I just think that there's better risk reward right now. That's going to be the video overview of my holding sentiment. Hopefully by the end of this week, I'll have another one on my watch list. On all the companies I'm keeping track of, I'm going to renew my analysis, tell you whether or not I feel bullish on them or I feel bearish on them, and some thoughts on the valuation. That's going to be another exclusive later this week, so I hope you enjoy.